Hey everybody, this is Jose here. We are about to get started. I would like to have a quick sound check if that's okay, as we always do before we start the session, so we know all is good with sound and so on. So please, if you can, a quick message on the chat box, quick hello. That would tell me not only that it's a kind thing to say to everyone to say hello, but on top of that, I will know that you have heard me, so sound is good. So we are ready to go. How are you, Mark? Thank you so much for that. This is good to see you. How are you, Joe? Jeff? Wonderful, guys. Perfect. So we just got like 20 plus seconds to go and we start, okay? Very good. Here we go. 10 seconds to go. Almost there. That's it. Top of the hour, everybody. Welcome to the session. This is Jose Blasco. This is Options with Options. Today is March 30, 2022. And of course, as the name of the session suggests, if you're new to it, what we do here is to trade options. So we're going to be looking at the options markets, understand what's happening, looking for opportunities, etc., etc. Before we get started, I would like to highlight our disclaimer, as always, on the upper left side of the screen. Please read it carefully. It is important information. It is fairly short, so please do not skip it. I am counting on you to read it completely because it is indeed important. Very good. Thank you so much. How are you, Christian? Good to see you. Agenda for today, as always, we're going to be looking at the market, reviewing the trades that we have, and talk about trade management if needed, which it is, as you will see. And from there, we're going to be at new opportunities in the market and go for it. So that's the plan. I will close the introduction slide. I also want to point at the question page. Let me highlight the URL to get here. Here we go, tradewithufos.com/Jose. You come to here, and the really important part on this page is the section where you can actually search for answers or post questions. When you post questions, you have to log in. Anyone can do it. You just have to log in, click on the red button, and from there you can then add screenshots of the charts and things of that sort. So yeah, we can have a visual understanding of the question so we can give proper answers. Strongly recommend that you start here when you have to communicate with our support team, even though, of course, you are more than welcome to send an email if you need as well, if your question is a bit more delicate, if you wish, and you would not like it to be visible to everyone. Okay, so we're here to help. Just keep that in mind. Closing this window now and moving into top, and let's begin our market analysis. This is SPY, the S&P 500 ETF. And let me see one moment. So I'll make sure I get the chat in front of me so that way you guys can interact with me more easily. So this is the S&P 500 ETF. And as always, we're going to start our market analysis by looking at the climate, which we could see here, the climate on a daily time frame. The climate is currently confirmed and blue. And this climate has been running for 11 candles, where statistics suggest that 6 is a normal thing to happen. Anything above that is less normal. Anything below that is not so normal either. And therefore has should have a statistical behavior of change. In this case, from blue to red, if it was red, from red to blue. So in other words, we're in a market which has been statistically moving in this direction for too long, and a change of direction would be expected. A change of direction doesn't mean a whole market crash. A change of direction in this case refers to a red climate of 3 candles of duration. That would be the normal duration for a down climate. I guess we all know, especially if you have been in the sessions for a while and you attend regularly, that we all know that the market has been difficult, especially since the conflict in Russia, Ukraine started, etc., etc. We've seen a lot of behaviors that were not too aligned with what statistics suggest. In any case, statistics are the best guide to be mechanical and objective instead of having a guess. And now, because something's happening in the world, guess something's going to happen in the market with no statistical evidence of it. So important information here, and the point I'm trying to make here. How are you, Ahmed? Good to see you. The point I'm trying to make is that we gotta be careful when we are in a market condition of this sort, because while it could last longer, we've seen it. We had cases in the past. If I go back in time, look at that. Look at this blue climate, super long duration, really impressive market move. Okay, but again, this is not a normal thing to happen. At least that's what statistics suggest. So we gotta be careful, and we need to hedge ourselves if you have too much longs. Entering shorts is a bit too soon, unless you are an aggressive counter trend trader. Nothing wrong with that, as long as you have a valid set of rules to do it, but it's more aggressive, obviously. If you are mostly long, the fact that the S&P is likely going to produce a change of climate sooner than later is a good opportunity to do some hedging on the account. And if you are entering new positions and you don't have too much to hedge, because maybe you have been closing plenty of the longs given this beautiful move and you already collected profits from those trades and you have nothing to hedge, well then non-directional trading, it's probably the best way to go, to give yourself, a wide range, lots of wiggle room for the market to define itself, and make money on volatility changes, make money on time passing, and other ways while you're waiting for the market to define itself. Okay, so trading is a patience game. I love my first language, as most of you probably know, is Spanish. English is my second language, so when I was learning English, I would pay a lot of attention to certain expressions. There is one English expression which is very good for traders, which is sitting on your hands, which is a very visual thing to be done. To be honest, even when you are training yourself as a new trader, it's actually a good thing to physically sit on your hands. So you are kind of like programming yourself to, doing that, lack of action, if you wish, being patient, if you wish, which is something very important. Waiting for the right time to take action, it's key. The beauty with options is that we can do many more things apart from being directional, and therefore, in cases like this, you've seen me do it many times. Non-directional trading is something that, it's very convenient. Okay, so this is what we have. One more comment about the climate. On that particular day, we reached a peak of the 8-year spread of 169. That's the highest it went, where two standard deviations, not one standard deviation, but two standard deviations of max distance happens to be 0.8 for up climates. So in other words, we can tell that statistically speaking, not only this market has been moving up for too long without a breather, without some sort of a correction, a 3-day red climate, we didn't have that, but on top of that, not only it's been happening for too long, it's been happening in a way where price has traveled too far, too fast. 169 out of 0.80, that's not a joke. It's a very large move, and therefore the suggestion here is that's statistically unsustainable. On top of that, what's happening today is that we are having this Elliot wave turning point that is appearing on the chart. I'm not surprised, given everything we just discussed. Price action today is moving lower just by a little bit, 0.42% down, and this is generating a potential long-term Elliot wave indication for a new wave pointing down to be created for a long-term move. Orange color is long-term. Again, a long-term move in the context of a daily time frame is, maybe a few weeks. It's not that we are not talking about, we're talking about price going to 425, right? So we are not talking about the end of the world. So in any case, I just said, let's keep it easy, because while the Elliott wave seems to be forming here, the indication, the candle has not closed today, and therefore calling this a signal without the candle having closed, it's basically being a little bit too fast, okay? And we want to make sure that we act on the trades when the timing is right. So tomorrow we are meeting again, so we'll talk about it, okay? And two things may happen. The signal may still be there, and therefore we could, even though it's a little bit more aggressive, because we will not have a change of climate tomorrow unless the market crashes like crazy today. It would be a bit aggressive, but certainly we can plan on shorts, knowing that the market is very overextended in many ways. So we can start planning on those trades a bit more aggressively. And if you want me to do that tomorrow, since we are meeting again, we can discuss it. But today, while the indication is here, remember, acting on it, it's probably going to get you, way too soon. There are many cases where you have an indication during intraday times, and then the market moves in the opposite direction. Let's say the market rallies a bit higher, and next thing you know, now that signal goes away because price behavior does not correspond to what a beginning of an Elliott wave would be, and therefore the signal goes away. So long story short, we wait until tomorrow to deal with that one. But I wanted to make this comment because some of you may see it and there may be some temptation to act, and I need to make sure everybody is safe. And if you take extra risk, it's fine, but as long as it's in the context of your plan, okay? One more thing I wanted to say as well is that at that particular time, we had an Elliott wave, and yesterday, price action managed to go above that very relevant pivot high. So in other words, the market, it's to be honest, is looking very strong. But the issue is that getting in now is late to the party based on the climate definition. So we gotta be patient one more time, wait for some sort of a change to a red climate. Maybe the market needs to come down, somewhere here. And after the market comes down here, which may coincide with some of those UFOs, so then we may have a resuming process on this blue climate. And now getting in could be the recipe for very powerful trades to the upside, because the market is really showing plenty of strength here. This is a clear, very strong impulse to the upside. So now for the conservative traders in the room, the very, very clear indication that the market is going higher would be breaking the end of this Elliott wave, which is when the Elliott wave to the downside is proven to be wrong. Again, all of this will depend on price behavior today, but I'm just giving you two very important key points that could be used when managing a portfolio to decide, okay, I'm going to add more positions, I'm going to hedge less. So crossing this pivot high, it's giving you a clear confirmation that the behavior of the market is very strong. Crossing the upper one, even stronger. Okay, so when managing a portfolio, when it comes to deciding how many trades you want to be running to the long side, how many trades you will be running to the short side. So this has been a very important indication yesterday when crossing above this high. Long analysis today, but again, lots of information to go over, and I'm a little bit less in a rush today compared to other sessions, given the fact that we are meeting again tomorrow. So I'm happy to add a bit more details. Also, a little bit of a note of caution here with the implied volatility of the puts above the implied volatility of the calls, which is kind of a contradiction compared to what I just said, isn't it? So what I just said is that everything is very bullish, but next thing you know, we have implied volatility of the puts above implied volatility of the calls, gray above the blue. That's bearish. Okay, and again, to be safe, as we said, we need to wait for the climate to go red, and then when this blue line crosses the gray line, so now really you have a lot of evidence that the market is, from a statistical point of view, very likely going to continue to the upside. So we need to wait for that. The reason why the gray value is above the blue, it's probably because the same type of analysis that I'm doing here is being done by other experienced traders out there in the world, and many people are buying puts for hedging purposes, or entering into some short opportunities for hedging purposes, and that's why the puts are a little higher. Notice that a few days ago, I believe it was last week, and I believe this is when we met, or kind of like when we met, there was a moment in time where the blue line was either matching or above the gray line, okay? But again, this was basically happening when the climate was reaching its statistical end. So from there, even though the market has been managing to move way higher, the reality is that there is a little bit of a conservative approach there in the sense of buying a lot of protective puts or some heavy short trades for probably hedging purposes. Okay. Now, remember, and I'm reading you, Joe. You read my mind. I love it. We are in sync, and I really like to be all in sync, because it means that we are developing the process, the thinking, the methods, and so on. And we can see today, if I refresh the volume map, that implied volatility of calls and puts today is being matched right now, 16 for the call, 16 for the put. Earlier in the day, and maybe this is the reason for your comment, Joe, I saw the calls slightly higher. So So that's what it is. And again, um, a bit more trading of the puts than the calls at this moment in time. Not a surprise. The market is falling, so not a surprise. But while the market is falling, notice how the calls and the puts are matching. So um, I don't see anything heavily bearish in the market at this moment in time. Actually, I see it as quite bullish. The only problem is that from a timing point of view, we are late to the party if today was your choice to get long in many stocks, okay? Because again, climate is overextended, we still are lacking the evidence for the implied volatility of the puts to be below the calls as an average. You probably remember I always pointed the fact that my bottom left chart is the 3-day average of implied volatility. So, again, from a timing point of view, for you to be directional, for us traders to be directional based on the rules I utilize in trading, it's time to sit on hands. Okay, and that's why I was making that comment earlier. But the market is really defining itself compared to conversation we had a few weeks ago, especially coinciding with the beginning of the conflict with Ukraine and other crazy things. Yeah, so your options are not showing today's strike. Today's strike. Oh yes, yes. That's because of the settings I use. So if I look at in the settings, um, wait a moment. Skip weekly ending in 2 days. Okay, so the weekly expression days that end in 2 days are removed from my screen. Okay, just to focus on something just a bit beyond 2 days, if you wish. Okay, so that I believe that should be the reason why in your case it may show yes, yeah, 2-day expiration doesn't show because of that. Okay. Cool. Okay. Very good, everybody. So one last thing to be done, the VIX. Okay, and I guess we are all guessing it, apart from we're all watching it. The VIX is down, isn't it? I mean, down overall. Today is higher by 2.88%, but is down overall. We're trading at levels of 19. So again, if we were to talk about, I want to be non-directional, which is what I said, right? But volatility is low. Well, you guys tell me on the chat box. Okay, I'd love to see your responses there to see how you follow in prior sessions. And again, there is no right or wrong. Okay, we're here to learn. This is a private room. Even though we're streaming on YouTube, is unlisted, so no one sees it. Even later when we post a recording, no one will see it. So just for our eyes only, and no one is to be shy. When we want to be non-directional and volatility is low, what is the type of trade that I normally utilize? Anyone would like to type the name of the strategy I often use in cases like that? Go ahead and do it on the chat box, please. And if you're not sure, just type "not sure" if you don't mind. So at least I know you have responded. So I'm not focusing on waiting for the responses. I can focus on the session as well. So yeah. So anyway, I'm gonna go back to the S&P chart, and I'm gonna start loading the my positions chart so we can talk about the positions. Very good, Jeff. Exactly. Double diagonals. Very good, Mark. Very good. Double diagonal. Which actually, technically speaking, I just almost felt in a little bit of a trap here. It's not a double diagonal. What I normally do is a double calendar, which on the last week is then converted to double diagonal. Okay, but it's kind of the same. Okay, so I'll say it's good. And by the way, I myself many times say double diagonal instead of double calendar. I'm sure you have caught me doing that many times, which is probably the reason why you said double diagonal. So if that's my fault, sorry for that, my friends. Anyway, so Caterpillar, super quick review. This is the Iron Condor that we had running. This one expired on the 25th of March, so this trade is over. This trade ended trading here inside the purple area. Thank you, Mr. UFO. When price came there, bring it back down. All very nice. A book trade, if you wish. Nothing to comment. It was an easy one. No management. No anything. Okay. So yeah. So that's it. Done with the Caterpillar trade. If there is any question, let me know. And I was about to erase it, but I see a question there. concerning the difference between a double diagonal and a double calendar. So let me answer that. And in the meantime, if you have questions related to Caterpillar, please type it on the chat box. So I'm just going to be visual here and just put it on the screen. Okay, even though this is Caterpillar, just ignore the chart. Just pretend it's a white space. So a double diagonal looks exactly the same as well, it doesn't look exactly the same, almost exactly the same as an iron condor. You know what? Maybe I'm just gonna have here iron condor. Okay. Next, I'm gonna have double diagonal, and next I'm gonna have double calendar. Okay, so that way we can really compare and understand the differences between the three. So if I was to use my plus C minus C plus P minus P, which is the normal nomenclature I use, so I would say an iron condor is you have a bear call spread above and you have a bull put spread below. Okay, so sell put by put below, sell call by call above, right? Now with a double diagonal, so instead of like that, it's not exactly like that. It's you sell the call above and you buy the call below, and you buy the put below and sell the put all the way below everything. Okay, so notice how the plus and the minus signs are inverted, but there is another major difference for that, which is the reason for the word diagonal, which is the expiration dates are different. With an iron condor, these two options use the same expiration date. Okay, same expiration. Okay, those two below, same thing, same expiration. Okay, so the options above and below use the same expiration date. Okay, the double diagonal does not. So with the double diagonal, the options that we buy, use a longer term expiration date. Okay, so I'm just gonna add plus plus plus. Okay, longer expiration date, where the ones that we sell are using shorter expiration date, typically weeklies, right? And the way we construct it. Okay, so I guess that was clear, but visually speaking, I guess it may help beyond, right? Now, what is the double calendar? Well, the double calendar is like the double diagonal in the sense that it's going to use two different expiration dates, but we use the same strike. Okay, so we don't have one strike above and one strike below. We are actually using the same strike. Okay? So you buy a put, you sell a put, you buy a call, you sell a call, and they are the same strike, even though they use different expiration dates. So that's basically the difference between a double calendar and a double diagonal, where the strike is different when you use a diagonal. So what we are doing with the double calendars, okay, is that we are using those short call, short put, using typically the front week, and every week we roll them and roll them and roll them and roll them. But the last week you cannot roll them, because if the last week, when you reach the expiration date for that one, the ones that you are long, if the last week you happen to sell a call against the call you are long, well, that equals closing the call, closing the put, right? If you sell the same strike you own on the same expiration date, you are basically closing your trade. So what we do on the last week is that we take that call and we sell it above, and we take that put. Okay? We take that put and we sell it below, which is now giving you a double diagonal. So that's why I said that, and that's the reason why often I use the wrong strategy name, maybe because I'm thinking ahead or whatever. But basically, double diagonal, it's something that we do, but we do it as the last step, where we start those trades as double calendars. Okay, that's what we normally do. Any question about that? Is that clear, Christian, now? Let me know if that's the case. Okay, and there were no questions on Caterpillar, so I'm just going to delete it, and therefore I'm just going to focus on General Electric and Harley Davidson, which are the two trades that we have right now. So we're going to be looking at them and discuss what to do here, okay, what to do, and so on. So with this particular trade, and I believe I documented it here on the other screen. Yes, correct. So we entered on this particular day. That was 324. Okay, so 324 was that day. Okay, so this is the day when we enter the trade, and from there, notice how the stock is basically trading at the same level. Okay. Now the other thing that we can see is that if you look at the implied volatility on the 24, it was 30, where the volatility today is 30. So we didn't have any increase in implied volatility, so the trade is not really benefiting. Thank you so much, Christian. Yes, you're right. To be honest, yeah, we should have talked about this before. Thanks for asking the question, Christian. So the implied volatility is at the same level. So in that sense, we didn't get the boost that we are expecting to get as earnings are approaching. Remember, we are doing these trades, making it coincide with the earnings date, so we can benefit from the rise in implied volatility, which obviously has not happened here yet. Now, the one thing that happened though is that the options that we sold, okay, we bought the 98 call and sold the 98 call. We bought the 86 put and sold the 86 put. So those options that we sold, the call we sold and the put we sold, that were front week, they have been losing value as time passed. So the question is, have they lost enough value so we can roll them and better the trade as we are waiting for that earnings report to get closer in time and the rise of volatility and profit from that? Or is it not time to manage, right? So that's the question. And to answer this question, so we're gonna right click and go to the risk graph. By the way, everybody should have received the last update of the platform, isn't it? And in that last update, there was an improvement on the risk graph. So I believe that all of you should have received that. Okay. So anyway, so take a look. We have this position with General Electric. Okay. So here's the position, and the idea is, let me compare spread, so you see what I'm gonna do. Okay. So notice that we have April 1st expiration 98 call and 87. To be honest, I don't have it right on the charts. Okay. Here we go. 98 and 87. Okay, this is much better. So, so the key here is that the April 1st 98 call is currently trading at 6 to 7 cents. We sold it at 41. And the 87 put that expires on Friday, April 1st, is currently trading at 0 to 2 cents. We sold it at 24. So the question is, should we close those April 1st options and sell the April 8th, which is the next Friday? Should we do that? Okay, is it time to do it or not? Because again, by doing that, okay, what we're gonna do is that we're gonna improve the performance of this trade, in many different ways. Okay, so currently the risk of this trade, as you can see, is $335 per contract. But if we bring in new credit thanks to selling new options that expire on the week after, that's gonna improve the trade. Okay, now for us to do that, we had some rules, which I am kind of reviewing. I'm not rushing too much again today because, we're meeting again tomorrow. But basically, what I care about GE at the moment is to compare April 1st and April 8th, okay? And the only strikes I care about is 87 and 98. Those are the only strikes I care about. So when looking at this, okay, again, the 87 put is trading at 2 cents, as we know. The 87 put in the next expiration date is 19 cents or 17. So, you would think, let's go ahead and tweet and roll it, right? And so buy back the 87 on April 1st and sell the April 8th. Same is happening with the calls. The calls on the next expiration date are trading around 40 something cents. In the current expiration date, they are trading at 6 cents. So if you close it and sell the next one, so basically you're gonna collect, again, like $40 in credit, lowering the risk of the trade by $40. Is it worth it to do it or not? Well, we have a method in which basically has us look at the theta available on, let's begin with the call, the 98 call on the front week, which is 14 cents. And if you take 14 cents, which is the current theta presented by the platform, and you multiply these times the amount of days to expiration, which is 2, so 14 times 2 equal 28 cents. So that means that, if theory equals reality, and you wait until April 1st expiration, you're going to make 28 cents. But the reality is that those options are trading for 7 cents only. So that means that there's no way you can make 28 cents, even though the Greeks tells you so. That's when the Greeks get in that distorted stage as we are getting close to the expiration date, or we are getting a bit too far out of the money, or a bit too far in the money and closer to the expiration. So the Greeks get distorted, okay? And we evaluate that distortion during this very simple process, which is, accurate enough. Okay, it's super simple. Okay, we could make this more accurate, but to be honest, we don't need. So 14 times 2 equal 28. This is 7. 7 is way less than 28. So let's roll it. So how do you roll it? I'm gonna bring in TOS here, and the way we're gonna start with the call side. So the call side is here, right? So you're gonna take the call side, right click, and create a rolling order. Okay, waiting for data. Interesting. Okay, now, so we're gonna roll it, and rolling it means that you are buying back the 98 call that expires on April 1st, and you are selling the same strike 98 call that expires on April 8th. And if you do that, you are supposed to get a net credit for it of 38 cents. Okay, so I'm just gonna do it, see if we get filled, and if we don't get filled, I'll push it, because as you know, I want these things to get filled during the session so I can comment on it in the future sessions for education purposes. When you are doing the trade yourself, as always, be patient, okay? Negotiate your entry prices, 1 cent at a time, no rush, etc., etc., okay? Christian, love the new math in the risk graph. Wonderful. Happy to hear. Happy to hear. Very, very happy. So anyway, so it doesn't seem that we are getting filled. So let me try to push this to get just a little bit less credit. Maybe we'll ask for 36. Let's see if we get filled. So far, it's not giving us the fill. Okay, so I'm just going to do the crazy thing. So please, you guys, don't do the crazy thing, which is I'm going to use a market order just so I get it filled as soon as possible. And if I don't get filled quickly with a market order, it means that there is, a pretty serious lack of liquidity or an issue with the simulated account with TOS. Okay, now we just got filled at 38. Here we go. Give me, beautiful simulated price improvement, which in the real world may not happen this way. So negotiate your prices, okay? But anyway, I got 45 and 7. Okay, I got 45 and 7. So that's a net credit of 38, okay? So in other words, if you look at what I have, if I look at my positions, so for the 98 call that expires in April 1st, I got paid 41 cents, okay? So let me grab a calculator here. Okay, here we go. So I got 41 cents, right? So those 41 cents were not net profit, even though I got 41 cents. Why? Because I bought back the April 1st at 7. So instead of 41, I lost 7 cents in the process. So I made 34, right, cents of profit. And now I just added 45 more, okay, which basically tells me that it's, I've done it in 2 shots, but it's like I've got a total of 79 cents for that 98 call. So how am I going to simulate that on the platform? Very simple. I'm going to come back to the risk graph, edit, and what I'm going to do here is I'm going to change the 98 call that is April 1st. I'm going to change it to April 8th, and I'm going to change those 41 cents to the value we just calculated with 79. Okay, that's 79. Okay, and when I click OK, of course, the shape of the graph is going to be different. Notice that the orange line now has less risk. The orange line is above the blue line. But notice also that then it's kind of like falling like that. So again, that's not an issue because this is plotting all the way to April 1st. It's not plotting to April 8 because we still have an April 1st option in here. Okay, so let's evaluate if we got distorted Greeks on the put. That's the 87 put, and if we do, we're gonna roll it to April 8, and then we're gonna have everything April 8, and we're gonna be able to reevaluate this trade. So with the 87 put, so we are talking about a theta of 7 cents. 7 cents times 2 equal 14 cents, where the ask price of this trade is 2 cents. So in other words, 2 is less than 14. So again, we are dealing with distorted Greeks at this moment in time with the front wick, and we are going to go ahead and do the roll as well. Now, I believe this market has been moving higher a bit. Yes. So we may get, we should get less premium for the put than what we got for the call. But, it doesn't matter. It's what it is. It's the process. Okay. So we got April 1st, 87 put, right click, create a rolling order. And when rolling this, we're going to do it for 16 cents, which is much less. Again, I'm just going to try to save myself time. Please do not do market orders with options, okay? Ever, okay? But I'm going to do it just to speed up the time of being filled so we don't waste time. Let's see if I get filled soon. Okay, I just got filled. Okay, I got 15 cents in this simulation. Okay, I believe this is doable. You should be able to get that. So let's do the same math we did before. So if I look at the original trade, did I keep? Yes, here. So I got 24 cents last time we did it with the put. Okay, so 24 cents. That's what I got, and I bought it back for 1 cent. Okay? So basically, I made 23 cents with that option. Okay, you can see I bought it back at 1 cent, and then I sold a new one at 16. So that means that I collected 23 plus 16. I collected a total of 39 cents as a credit for that particular strike, which I did in 2 shots. So I'm going to do the same exercise. Get the 87 put, change April 1st to April 8, okay, and 24 becomes 39. Now if I do that, notice how the risk graph has changed, okay? The orange line is now above the blue line in most places, okay? Of course, in the middle, it's never going to look as good as on the extremes. On the extremes, you can see we went from a risk of 335 to 282, okay, 335, 327 to 276. So the most you can lose here is 282 now. So we have reduced the risk of the trade nicely in this 1 week. And again, what we're waiting to happen is for volatility to rise, where if that's the case, look at that. Here we go. We got the green zone appearing in the middle. Okay, so again, what we're doing now is not a trade where what you see on the risk profile is the end of the story. What you see on the risk profile is the story developing, and that's why I'm giving you all those details so you can understand. You got 40 for the roll. Very good, Mark. Better than me. Wonderful. Love that. So let me copy the evolve position here. Here we go. We have it. And now we're going to be able to track this. Okay, so here we go. Okay. Let me know if there is any question. I'm about to move to HOG. Let me know if there are any questions so I can address it. In the meantime, I'm going to load HOG. HOG. So with HOG, we entered the trade. I believe it was the same day, right? Yes, on the 24th. So that was here. Okay. And as you can see here, there is a big difference. Okay, because that stock has moved from 38 to almost $40 per share, $39.95. So while GE kind of stayed flat, Harley Davidson moved. So obviously, when it comes to managing the trade, there will be implications that we need to discuss. And beyond implications, okay, and depending on how you approach it, you may even have, if you got distracted, you may even have risk of assignment, which again, it's called risk of assignment, so I pronounced the word risk. But again, if you know what you're doing, you may get a sign on an option, but then you are long or short. You are long a call or a put together at the same time. So the risk is whatever the risk profile shows. It's not like you got extra risk if you get a sign in a context like this. Okay, the one thing that does happen though is that you have a relevant change in margin and buying power implications, and depending on the account size and so on, and other positions you may have open. So this could be a problem. Okay, so this is something that you always need to keep in mind where you are doing the rolls and the tweaks, where sometimes you may decide, not to tweak, not to roll, because you are willing to accept assignment, but other times you may want to actually process those roles sooner, so you avoid any sort of risk of early assignment or early exercise, and therefore early assignment. Okay. Christian, I watched last session's recording a day later and entered a 3 with a 312 risk for G. My 98 call was 4 cents, so I wait for the roll. P is the same. You sold the 98 call at 4 cents, Christian? You mean 4 cents or 40 cents? Please let me know if I understood that right. So anyway, so let's do the same mechanics here with HOG. So here we care about April 1st and April 8th. And the strikes that we care about are 40 and 35. Okay, so 40 and 35. Those are the strikes that we care about. Let me update here so we have it really set on the chart. 40 and 35. So let's add those here. 40 and we got 35. Okay, and so here's what's gonna happen. Okay, so first of all, 40 is basically at the money. Okay, it's actually 1 cent away from at the money, so it's at the money all the way. So we are talking about an option which is at the money with a 40 call, and we are talking about an option with a 35 put, which is extremely far out of the money. Okay, extremely far out of the money. So we are talking about those two cases. What's the issue with the ones that are very far out of the money? Well, you may not have liquidity to be able to get filled on the roll. And if you cannot get filled on the roll, you're going to let it expire and sell a new one on Monday. Okay? It's not that different. Sometimes you may get lucky and the Monday opens gapping down on Monday and you get a bit more for that put. I personally try to get it filled during the week so I can get 2 more days of time decay, which is the weekend, right? If you sell an option on Monday because you had to let it expire on Friday, so you miss on 2 days of decay. And even though this is kind of like priced in the options and you technically miss less than 2 days of decay, you do miss on some. So I prefer to do it if possible during the week. But we may be dealing with a case where you may not be able to, because, I mean, zero volume, no bid. I mean, we're gonna be bidding, and there is someone willing to sell, so maybe we get 5 cents to get out. We'll see, but we may not be able to get filled when options are when the price has moved and the strike is so far from the current price. It becomes delicate, it becomes complicated. And then when options are close to at the money, so you get often less distortion on the Greeks, on the theta in this case. So often when you are close to at the money, you may need to add a bit more patience, and maybe you end up doing the tweak or the roll on Friday or Thursday, meaning towards the end of the week, because maybe if you try too soon in the week, you just don't get distorted Greeks at all. Okay, to me it looks like we may have it. Not fully sure, but it's gonna be close. Okay, in any case, I plan to do it so I can demonstrate how to do it. So we got the 40 call here with a theta of 25 and 2 days to go. So I guess it's pretty basic math, but if you do 25 times 2, so that's 50 cents, right? And if you look at the price of that option, it's trading between 45 and 55, where the midpoint is exactly 50. Okay, so it's exactly time. If it was just a bit more, it's exactly time to do it. So technically speaking, maybe we need to wait till tomorrow, something like that. But again, just so we have it done, I'm just gonna do it today because fair enough. I mean, we are right there in the middle. Okay. So I'm just gonna do it. So actually, if you do the math very accurately, 2580 times 2 is a bit more than 50. So I guess it's time to do it. But you see the difference, right? So if instead of looking at the 40 call, which is at the money, you look at the 35 put, right? And what's the theta for the 45 put? Well, the theta is 21. So 21 cents times 2, that's 42 cents, where the price is 10 cents. It's way less. So the level of distortion on the Greek calculation on those far out of the money options is way more compared to the one that is at the money. Okay, so the other money is almost always the one that is the most accurate, and from a Greek calculation point of view, and the other ones are more arbitrary. Okay. So anyway, we're gonna do it. So let's go ahead and look at our HOG trade. We have the 40 call. I'm gonna right click to roll it. And if we roll it from April 1st to April 8th, not trade it. Okay, now it seems that we're gonna get 37. Okay, so let me go back to the platform. Let me go back to the positions. Let me get HOG on a risk graph. Okay, and now that we have HOG on a risk graph, let me go ahead and compare spreads so we can evaluate the whole thing. Okay, very good. So let's do the roll again. To save time, I'm going to use a market order. We got filled at 35. Thank you very much. So that means that I paid 50 to get out, and I sold and I got 85. Okay, so let's do the math. So when we sold the call on April 1st, we got 25 cents. Okay, that's what we got when we sold the call. So we sold the call at 25 cents. Okay, and now we just bought it back at 50. We bought it back at 50, which means that we lost 25 cents on that call. Okay, buy it back at 50. So we are negative 25, right? Why are we negative 25? Well, because the market went up, and therefore the call gained value. So we are buying it back for more. So therefore we are losing money, right? But also the new one you sell using April 8 is going to pay you more, which, to be specific, more is here we go. More is 85 cents. Okay, so 85 cents plus 85 means that the net total amount of credit collected, if you put the two together, is actually 60 cents. Okay, 60 cents. So in other words, the way to simulate this so you can track your trades is to come in here and be like, okay, the 40 call now is the April 8, and that 25 is now equivalent to 60. Okay, so that's what we have, and you're gonna see a similar graph compared to what we had before. So the risk is way less. Okay, the risk is way less now, but then the orange line is going down again. Why? Because all of this is being simulated. You can see here to April 1st. Okay, that's the simulation we got. You can also see it here. The blue line is April 1st. The orange line is April 1st. Okay, so we are simulating up to April 1st, and we need to add the other put. Okay, well, the other put, we saw it already that the Greeks were totally distorted. Okay, so 21 cents of theta for the 35 put times 2, that's 42 cents. We only got 10, so that's totally distorted. Bad news is that the 35 put on the next expiration date is paying extremely little. Okay, it's really paying nothing. So, the role is kind of like a waste of time, and you have to pay commissions for such waste of time. So in cases like that, it's often better to wait until Monday and do it. But let me try and see what we get. So if I do 35 put on April 1st and we create a rolling order. So this is going to pay you 2 cents if you roll. Okay. So no way I'm going to roll. It doesn't make sense. Okay. Instead, what I'm going to do is I'm gonna wait until Monday and let the April 1st expire. So you're gonna make the full credit that you collected and you pay no commissions. And then on Monday, I'm gonna sell a new option, which is very likely going to pay me more than 2 cents. Is that making sense? So I'm gonna have to wait because doing it now, it makes no sense to get 2 cents, right? So anyway, so I'm gonna delete this, okay? And the way you could kind of automate it if you wish, okay? It's the following. So on April 8th, okay, you can go ahead and look at selling the 35 put, okay? And right now this is trading for nothing. But anyway, you can maybe you can set a minimum price or something like that. So maybe I'm gonna sell it for 15 cents minimum, but I'm not gonna do it now. So what I will do is set an activation rule for this trade to be submitted on Monday, which is April 4. And again, not to get too much slippage, I'll wait until this is New York time, so I'll wait until 9:40, something like that. Okay, so 10 minutes after the open, the options prices should stabilize. If you want to be a bit more conservative, maybe 15 minutes, it should stabilize, and then you sell that option. Okay, and because it's a limit order, if that option is trading at 40, you look at 40. But if it's less than 15, you will simply not get filled. Okay, so again, this is not something for you to put in the system and forget. You certainly need to review it, especially if the market was to start falling hard. You don't want to find yourself filled on Monday while you are assigned stock shares at the same time already, because if the market was to fall crazy hard and hit 35 or below before Friday, so you may have a problem. So you don't want this to be the case. You may protect yourself a bit more, by saying that you need the market to be above 35. Okay, so if Harley Davidson is above 35, then you are open to sell the put. If it's below 35, well, that's bad, because that probably means that on Friday you got assigned on a put already, and now you're selling another put. You're not supposed to do that because you only have one long put for protection. You don't have two, right? So again, this is a way to kind of like make your life easier and not to forget you want to do this trade. But at the same time, I would certainly review this manually and be there. And certainly on Friday, evaluate if I'm gonna cancel this order or still have it. Okay, and so this is not set and forget 100%, but it's just out of convenience. One thing you can do to help yourself. Okay, so I'm gonna place the order here. Okay, it's right there. It's a good till cancel order, and nothing is gonna happen unless we reach that date. Okay, well, next Monday. So basically, the trade I am reviewing now, okay, will end up as something like that. Okay, it's gonna be at least equivalent to April 8 with 20 cents. Okay, it's gonna be at least equivalent to April 8 with 20 cents. But again, let's say we get another 15 cents. So instead of 20, it's gonna be 35. Okay, so that would be kind of like the trade that we're gonna get, assuming I'm gonna get filled. Okay, so now if that was the case, so again, same story. We are really reducing the risk of the trade. So the risk of the trade went from 150 to 105. Again, we look to be on the red zone. Of course, we're waiting for the rise of implied volatility, and next thing you know, now we are in the green. That's the play we are playing here. Okay, so again, we are building up into that moment. Okay, this is not what you see on the risk profile is not the end of the story. It's just the progress. Okay, the story developing. Okay, so I'm just gonna put HOG here, even though we know that number 35 is to be confirmed. On Monday when we get filled at whatever points we get. Do we sell the same 35 put? Yes, because we are dealing with double calendar all the way to the last week. Okay, if you were to change strike, then there are implications. If you do it below, then you are not adding risk, but you are not removing risk as efficiently. Okay, so if you diagonalize the bottom part of the puts, then meaning that you sell the put below the put you buy, below the put you currently own already. Okay, so let's say you do 35, 34. Okay, so if you sell the 34, you are diagonalizing it, and then you are not adding risk, but you are not removing that much risk at all. So we want to reduce the risk of the trade efficiently. So the 35 is going to be the best. And why not the 36, for example? Well, because if you do the 36, now you are adding risk to the trade. You are not removing risk, you are adding risk, apart from you are now giving the trade a little bit of a directional component, because you would have a bull put spread below instead of a calendar put below, right? So you are adding some directional component to the mix. So you change the risk profile and you add risk. It's not what we want to do. So we just keep working on the 35 all the way to the week prior to expiration. That's what we're going to do, okay? Cool, very nice, perfect. So as said today, and it was my plan, I took my time to do all the review. So tomorrow we don't have to review anything because General Electric and Haley Davidson, they are already managed. Even the 35 put that we said is not managed yet, we said it's going to happen on Monday. So tomorrow we don't need to talk about it, and we can just focus on putting new trades. So let's see what's happening in the market. Maybe we have a confirmation of the Elliot wave dot. And if that's the case, we can actually plan on short trades. It would be a great demonstration, apart from building more non-directional trades as well. And that would be a great session to be able to put 2-3 trades together of different types. So that could be very enriching, hopefully, and that would be my plan for tomorrow. The role for HOG Mark was a GTC order, could till cancel, because obviously being Monday, the date, and this, to be honest, varies from platform to platform. I'm not sure right now with TOS if you could. Actually, with TOS you can, now that I remember. Yes. Yeah. With TOS, you could have it as a day order. That would be fine. But with some platforms, if you use a future date and you use day order, then it would give you an error message or it would not work as expected. So that's why, in my mind, because it's Monday, I just went for GTC. But you have a point, Mark. With TOS, you could actually do day order and have a specific date. You could do both. Yeah. So, my friends, we got 3 minutes to go. I will obviously not rush into a trade in that amount of time. So we're going to conclude the session here. Questions, comments, feedbacks, anything, views, things you'd like me to address tomorrow, anything, guys. Let's use these very few minutes that we have for you guys to give me a little bit of feedback on the chat box, so that way I can prepare that for tomorrow and have a rich session for all of us. Oh, your question above, did I miss anything? Oh, yes, I missed something. 4 cents, yes, okay. So sold value is higher than buy. Yes, you're right, Christian. So you will need to wait. But I will go beyond that. When you build a trade of that sort, and you do it somewhere in the middle of the week, right? Too close to the end of the week, or maybe the stock is not too pricey, like HOG is not a very pricey stock, and therefore you get very little premium for the options that you plan to sell. Then I would start the trade by going to the next week, not the front week, because really, paying a commission just to get 4 cents of credit, you're basically guaranteed you will never have to roll, and then you are guaranteed you're going to miss the time decay over the weekend. So it's not going to be efficient. So, in my mind, that's why I use the number 15. And again, 15 is still very, very low. I prefer larger values. But again, when the stock is cheap, I would say 15 is kind of like the minimum, because if you don't get 15 cents, and then you need to roll, and when you roll, you may need to pay 5 to roll, and then pay commission. So you're left with nothing. So just watch for that when you are building a double calendar, or any trade where you're selling options, and you see that you're using a front week and it's paying you that little, just go for the next week. And instead of starting with 3 days to expiration on the options that you start with like 10 days to expiration. Is fine. In a perfect world, you do the front week, but it's okay to go for the next week, because again, in the end, my comment is about common sense, if you wish. Okay, it's not a hard rule, because you need to observe the option chain and do what makes the most sense. So that's why I'm using the term common sense. Got you. Got you. Very good. Yes, Mark. Yes, Jeff. Yes, Christian, Joe, everyone. Great. Perfect, guys. Love it. Thanks for joining me, as always. My pleasure, as always, to spending some time with you here. I love it, as you guys know. So thanks for coming to see me and spending all this time. And as always, very, very happy of your works and everything else. Just a quick update, guys. We are working very hard on the new website. I forgot to mention about the tool for interaction. Someone posted a message the other day. I forgot. It was one of you for sure, but I forgot who that was. But I saw a message the other day mentioning that there is not too much interaction on stock tweets. Where can we go to post and things like that. So good news, guys. It seems that we found what we think is going to be a valid solution to be integrated on our website. So you won't have to go anywhere. You'll be able to, turn on a meeting room, and you guys get together and meet and talk, share screen, use microphone, camera, everything else. So you'll be able to do it inside of our website, and so that way you guys can get organized and meet whenever and things like that. So we will have this running on a new website, which we are working on intensively. And we're still not that close as I would like, but we are indeed getting closer. Last week and this week is looking like lots of progress. So I'll share more about that. I think the conclusion was clear. Stock tweets was not a great success from your acceptance point of view, and therefore we're going to be building a tool for that. Okay, so yeah, that's it. My friends, see you tomorrow. Bye-bye. Take care. See you soon.